Have you ever looked at a massive hydroelectric dam, a sprawling international airport, or a whole field of wind turbines spinning on the horizon and just thought, how in the world did they pay for that? I mean, we're talking about projects so huge, so expensive, and so risky they seem to completely defy the normal rules of business. Well, today, we're going to pull back the curtain on the powerful and surprisingly old financial engine that makes these world-changing projects a reality.
Seriously, just think about it for a second. The stakes are absolutely massive. You need billions of dollars right up front. The construction alone could take 10, maybe even 20 years before you see a single dollar of revenue. And along the way, 1,000 things can go wrong. A traditional company loan just isn't going to cut it. So how do you solve a puzzle like that?
Okay, so let's get into the solution. And what's so fascinating here is that the answer isn't some brand new, complicated bit of financial wizardry. Nope. It's actually a powerful idea that's been sharpened and refined over centuries.
It's called project finance. And I know the name might sound a little dry, but trust me, its story is anything but. This is the tool that has literally built empires. It's connected entire continents, and now it's powering our future. And you can see just how far back this idea really goes. We're talking about the ancient Roman Empire, where merchants would fund super risky sea voyages using these early kinds of risk-sharing agreements. You fast forward to the Middle Ages, and you get joint stock companies, where people pooled their money to fund global exploration and trade. By the time the Industrial Revolution rolled around, the method was sophisticated enough to fund the Suez Canal, a mind-bogglingly huge project that was financed by creating a special company just for that purpose. And that same core idea? That's what we use today to build everything from our power grids to our 5G networks. So what makes modern project finance so special? What's the secret sauce? Well, it all comes down to one absolutely brilliant core concept: the ring fence. Here's the magic trick behind the whole thing. The lenders, the people putting up the money, they aren't looking at the sponsor company's overall bank account. Not at all. They are focused completely on the project's own future cash flow, the money the project itself is expected to make once it's up and running. It's like it exists in its own self-contained financial world. And this right here is the crucial difference. You see, in traditional corporate finance, if a company builds a new factory and it fails, the lenders can come after the entire parent company for their money. The whole company is on the hook. But with project finance, that ring fence acts like a financial fortress. If the project inside the fortress fails, lenders can only claim the assets inside those walls. The big sponsoring company outside, it's safe. This is called non-recourse financing, and it's the key that unlocks these massive, risky deals. So, how do you actually go about building this financial fortress? Well, it's definitely not a one-person job. It takes a whole specialized team and a very unique legal structure right at its heart. It all starts by creating a brand new, totally separate company just for this one single project. In the biz, this is known as a special purpose vehicle, or an SPV. You can think of it as the legal container for the project. It's the entity that owns the assets, takes on all the debt, and holds all the risk. It is the financial fortress. Now, this SPV becomes the central hub for a whole team of specialists. You've got the project sponsors, the people with the big vision. You have the lenders, the banks providing the cash. The government is key for permits and legal stuff. Then you hire a specialized construction firm to build it, and another company to operate it once it's done. And maybe most important of all, you have the off-takers. These are the customers who sign legally binding contracts, sometimes for decades, to buy whatever the project produces, like electricity. This whole intricate web cleverly spreads out the immense risk, so no single player gets wiped out if something goes wrong. Now, before any lender is going to commit billions of dollars to something like this, they perform the ultimate background check. It's called due diligence. And they scrutinize every single detail of the project to make absolutely sure it's a sound investment. This process is basically a super high-stakes checklist. First up, the financial check. Do the numbers actually add up? Will it make enough money? Check. Second, the technical check. Is the engineering solid? Can this thing physically be built? Check. Third, the legal check. Is all the paperwork, every permit, every contract in order? Check. And finally, the environmental check. Does it meet all the standards and laws? Check. Only when every single one of those boxes is ticked will the money finally start to flow. Okay, so after confirming the project is viable, that it can be built, the lenders have to answer the final, most important question of all. Is it actually going to be profitable? So to make that final call, lenders use a few key calculations. First, they look at something called net present value, or NPV. All this does is answer a really simple question. In today's money, is this project worth more than it costs?
They need that number to be positive. Next, they check the internal rate of return, the IRR, which is basically the project's estimated annual profit percentage, and that has to be higher than their minimum goal. And finally, they look at the payback period. How fast do we get our cash back? And for that one, shorter is always, always better.
So you see, this isn't just some abstract financial concept for bankers and engineers. Project finance is actively, right now, building the world all around us, and it's shaping our future.
In fact, you interact with projects funded this way every single day, probably without even realizing it. The power grid that lights your home, the airport you fly out of, the cell tower that gives you a signal, the solar farm providing clean energy down the road, these are the modern cathedrals of our infrastructure, and they're all made possible by this financing tool. And you know what? Its importance is only growing. As we try to tackle huge challenges like climate change, project finance is pretty much the perfect vehicle for funding those massive investments in renewable energy. It's the tool that allows us to take on the huge upfront costs and the decade-long risks that are absolutely essential to building a more sustainable future. Which brings us right back to where we started. This financial tool has consistently turned impossible ideas into reality. From the Suez Canal to the global internet backbone. So the real question isn't just about what it has built, but as we look to the challenges of the future, what seemingly impossible projects will it build next?